Hey, everybody, and welcome back to another episode. I'm your host, Brandon Cobb, co founder of HBG Capital. And today I've got Dave Seymour on the show. He is a renowned figure in the real estate industry. Him and I were chatting for a few minutes before this call. I was looking at his website and holy freaking cow. So he's known for his expertise in the multifamily real estate investment space. He's got dynamic presence as a host of the TV show Flipping Boston. As the CEO of Freedom Venture Investments, Dave leads with a focus on maximizing client returns through strategic investments in the multifamily commercial real estate space. His blue collar attitude in a white collar world sets him apart, making him a sought after advisor and partner for investors of all levels. He's also the author of the book Wealth Without Wall Street. We're going to get into some fun stuff today. This guy, he's currently got over $350 million of equity under management. That means that his portfolio is somewhere with a B. That's billion, if you don't know. He's been the host of TV shows. There's so much stuff to get into today. Dave, welcome to the show.
Brandon, thanks, man. Those introductions always crack me up because I look over my shoulder and I'm like, that guy sounds really cool. Who the heck is he talking about? And then, when you put it all down on paper and you have somebody else, put that information out there, it's kind of humbling for sure. So thanks for having me on, brother. I appreciate
Man,
it.
it's an absolute pleasure. Let's talk about this journey. You've got a multi-billion-dollar portfolio, $350 million of equity under management, host of a super popular TV show, Flipping Boston. There's a lot to get into, but for those that don't know you, what's your story?
Yeah, look, it's an interesting story, and I know we kind of bang around a 30-minute mark here, but in that introduction, the marketing guys put it in there, a blue collar attitude in a white collar world. And in the world today, we're in finance. It just happens that real estate is the vehicle that we use. But that blue collar attitude comes from my upbringing. I'm an immigrant to the United States, legal. Came over from England back in 1986, and I came to the States with a set of principles and a set of rules and understanding, if you will, around society and money, et cetera, et cetera. And it was from my blue collar background. My father was a heating and air conditioning guy. My mom worked in a bank. Nobody was rich. I grew up on the English equivalent of the projects. Give me a soccer ball and some grass, and I'm off and running. So, that was it. That was my lifestyle. So I was only ever trained to work my time for somebody else's money. Then when I come to America, I bounced around for a little while. I lived in Wheeling by God, West Virginia for a while. I was a Southern boy, moved up to New England a few years later. And up here, I was very blessed to take down a position that I loved, which was a firefighter and a paramedic. I worked 16 years in a city called Lynn, Massachusetts, which is just north of Boston, and absolutely loved it. But the challenge for me was, Brandon, I brought with me financial illiteracy because of my blue collar background. When you come to America, they got this really cool rule over here where you can actually spend more money than you earn, which my
Huh.
father thought was illegal. And I'm like, no, Dad, it's America. They'll give you credit. It's all good. But I had no fortitude. I had no mettle when it came to understanding finance. I was good at spending it. I didn't know how to invest it, save it, grow it. All I knew was I was waiting for the phone to ring for an overtime in the fire department so I could trade another 10 hours of time. But because of that, I then needed a second job and a third job. The marriage failed miserably. I had an 8-year-old son, and everything was just really bad, to be frank with you, man. But on my days off, I work construction, as a lot of firefighters tend to do. So for anybody listening, if you need good guys for good pricing, go to the firehouse and find your electricians, your plumbers, your GCs, your carpenters, your chippies, your roofers, your brickies. They're all in the firehouse. And I'll never forget it. It was a cold day in Boston. I'm working a job. I think we were trying to put a deck up, trying to get down to the frost line in Boston in January on an auger. It was horrible. And this car pulled up, and 4 people got out of the car, 2 beautiful women and 2 well-dressed men. And they were, late 20s, early 30s. And I said to the guy I was with, I said, who's that crew? He goes, they're the investors. I go, what? He goes, yeah, they're the investors. I'm like, what do you mean investors? He goes, well, they buy the house, we fix it up, they sell it, they make money. I'm like, well, their clothes look better than mine. They got a smile on their face. I'm like, so I asked them a few questions. And to be very frank with you, brother, they weren't that smart. They weren't that smart. Like a light bulb went off. And it was like this working smarter and harder, the old adage. And I started that journey, and I ended up attending a one of those traveling seminars, where I went for a 3-day class, and I learned some fundamentals. And my wife and I, my now wife Mary Beth and I, started learning lease options. I learned how to flip a property. I learned how to underwrite. I learned how to analyze. And we made an investment in ourselves, 2007, 2006, around that period of time. We made an investment in ourselves of $27,000 on credit cards that we couldn't afford. And I remember my wife said to me, she said, I love you. I
What was that
support you.
investment? What was the $27,000?
3 classes, 5-day classes. The
Okay.
organization back then was called the Whitney Organization. Russ Whitney, who was
Okay.
he was then bought out by Rich Dad Poor Dad, who was bought out by like, that industry's been pretty interesting to be affiliated and part of that. Because what I did was I was the student who actually went out and did what he invested money to do. Whereas a lot of people, oh, this is too hard, and then they complain and they walk away. Right?
Right.
If you don't have tenacity, if you don't have stick-to-itness, don't even start. Go home. Go sit on the couch and eat bonbons. But I brought that firefighter mentality into real estate investing. And I'll never forget, my first transaction was a wholesale deal. And it was I got a check from an attorney's office for $5,000. And it was a game changer for me, Brandon. It really was. Because the market cracked. It just, crapped out bad. And right through that crash period, people were like, Dave, what are you doing? I said, I'm a real estate investor. And they'd say, oh, I'm sorry. Like it was a disease, like leprosy back then, as the market was going through the challenges it had. And I just stuck with it, man. I just kept going and kept going and kept going. And that led into the TV show, because now I'm getting recognized because I'm the number two distressed asset buyer in my market, flipping these things around. And I'm making $20,000, $30,000, $40,000 on one single family home, when I was praying for 10 hours of time to trade for a $200 bump in my fire department paycheck. So that's the short version, brother. But it's been a journey for sure.
What period was this when you switched from firefighter to real estate?
Yeah, around 2010. Yeah, around 2010, I went full time.
So perfect time to get into it, but a lot of people don't realize that the market was still tough back then. People look back and go, "Oh man, all you had to do was just buy in 2010, and things would have been easy." But people don't realize that you almost couldn't get capital back then. It was very difficult. The whole system was freeze-dried. I mean, here the last, from 2014, 15 to 2022, I mean, you had hard money lenders just mailing people checks. It was so easy to get financing, very difficult to find deals. Now there's a lot of deals out there because of the market correction, but it's not easy to get capital. Banks have retreated to the sidelines. Investors have been kind of skittish. And so the market's very different. When you transition there, you started buying distressed assets from the bank. You became how did you get the TV show?
Yeah, that's a great question. I said to you, when I invested in that education, I actually did it and reaped the rewards of implementing what I was learning. And I guess I was a little bit of an anomaly or a special case. I always say I'm a little bit of a nutcase, but the folks in that industry recognized what I was doing, and they said, why don't you teach this? I'm like, I can't teach this. I'm still trying to pay down personal debt. Yeah, I'm making money, but I got a history that I got to clean up. They're like, look, man, just tell the story. Be truthful and tell your story. So when I moved into some of the education arenas while I'm working my business, I then began to rub elbows with internet marketing guys, your Gary V's and some other, well-known names today were part of a core group that I was kind of on the periphery on. You will be the common denominator of the 5 people you hang around with the most.
Yeah.
And Clickbait, the company Clickbait, Russell Brunson was in our group, and Russell Brunson sent me a link to apply for the TV show. And he just said, Dave, you're an Englishman in Boston. You're a firefighter. You're a funny bastard. You should do this thing. And I remember sitting in my basement in my house back in Lynn and filling out this vanilla application online. And I hope not to offend anybody, but it is what it is. I loaded it with profanity because I wanted to separate myself from the rest of the pack. Like I'd already understood enough in marketing. You know, Donald Trump, for example, why is he so well known? Because he's so controversial, right? What are you going to do to get yourself noticed? Right. And I loaded it with profanity. And long story short, they came out. They said, you're a funny bastard. We want you to be the big bad boy, contractor guy, firefighter guy. And that's how it started. And we were the #1 rated show for that time slot on A&E Network on a Saturday morning. And then that just propels everything, because now you're the perceived expert. Even if you're a complete and utter idiot, if you're on TV, you must be an expert, right?
Right.
And that put me on the Today Show. That put me on Squawk Box with Joe Kernan and Becky Quick. And, you know, I'm getting invited into the studio here in Boston to talk about real estate and the marketplace and capital. And it just, you know, it kept snowballing from there.
Man, that is so cool that you get to have that kind of experience, especially during that time period.
Yeah.
They're usually, when people start investing in real estate, I'd say actively. So you're going out, there's a big difference, right? You got passive guys who are like, I just want to invest the money and let somebody else like Dave do the work. Or there's active Dave, I'm going out, finding the deals, syndicating deals, putting together. I've noticed that for the active investors, guys like you and me, there's kind of a journey. Most people start out flipping houses, wholesaling, and they kind of graduate on to doing some bigger things in the commercial or multifamily or development space. When did that transition happen, and what did it look like?
Yeah, it was slow. It was a slow transition. It really was. And what happens is every investor in real estate gets to a point where they're like, this is hard work, right? If I don't flip a house, I don't get paid. Is my marketing budget getting recouped month after month? Does it make sense, right? Am I hitting KPIs, et cetera, et cetera? So then the tendency tends to focus towards that passive side. And though it's passive stroke active, you know, being a multifamily investor / landlord is part of the progression, or it was for me. I managed and own portfolios that you don't want to talk about. Like I've done the meth, I've done the dead bodies in my buildings. I've got some scars, brother.
Wait, dead bodies in the building? Tell us that story.
Oh, I had an 8 unit in Sanford, Maine, which is a pretty rough little town up here in New England. It's got a high meth challenge. And you know, one of the tenants, the old timer, hadn't been seen for a while, and my partner, who was managing the assets day to day, he's like, nobody's seen Bob. I'm like, well, how long? He was like 30 days. And Bob was no longer with us. At Dominato Spiritu Santi, he'd gone off to somewhere else, but he'd left his earthly carcass behind in a chair, and Bob was kind of like spreading out all over the apartment. So look, I've had drug raids in my properties. I've had a lot of challenges, man. But what that does is it creates a hierarchy, I feel, of emergencies. If you're thin-skinned and everything's an emergency, this business isn't for you. If you've been through some trials and tribulations, if you've failed forward consistently, then you've got some longevity in the building. So, you know, those smaller portfolios, your 1031 exchange, you cash out, you keep that money moving. Money has to be in motion. If it's sitting still, it's egregious. A friend of mine says money is like manure, right? If it sits still, it begins to stink. But if you sprinkle it around, stuff begins to grow. So that transitioned into, you know, multifamily portfolios. And then along with that, I've been a hard money lender. I've been a private lender. I've run a lending institution. And COVID was an interesting period, brother. It really was, because what COVID did was that shutdown of the economy really wiped out all of the amateur hour lenders, the amateur hour syndicators, the amateur hour investors. And I had a business that was working off of a $50 million line of credit to put hard money loans into buy, fix, and flip product. And I was shut down in 24 hours by Wall Street. They shut us down. They said your line of credit is no longer active. We're not doing any non-QM loans anymore. You're done. You can lend your own money. You're not lending ours and making money on the spread anymore. And I was blessed. I had 16 million in the pipe, and I was blessed that I was able to get those deals funded with other guys and girls that I knew in the industry.
Yeah.
But then there was that period of reflection, man. It's like, what do I want to be now when I grow up? It's like every 7 years there's a morphing or a change in me personally as well as my business. Long story short, again, I talked to a guy I'd known for years about my age group. I'm 58. My partner Walter just turned 60. And he's ex-Special Forces, retired from the military, Major Walter Novicki, and have been investing in Southwest Florida for about 30 years. And he turned it as a onesie twosie. Like he'd do, he'd do a repositioning on a 60 unit or 100 unit. He'd, build a 40 unit complex and sell it. Or, like he got some evolutions, if you will, in development and repositioning. And I called Walter. I said, look, dude, what are we doing, man? We this next 10, 15 years, we can't screw it up. We got to get it right. We got to, build off of what we've already got and then leave that legacy for our kids. And he said, well, if you raise the money, he said, why don't we expand this development side? And we really looked at repositioning through COVID. And again, thought it was a massive opportunity for repositioning. And then the government throws all the money in the market. And we saw the cap rates go down. Like all the distress that we anticipated didn't happen.
Nothing materialized.
So,
yeah.
No, it's great. It's gonna in the next 18 to 24. But anyway, we then positioned over to ground up development work. And that's the big part of where we are today. So we raised that capital, got a couple of family offices, a lot of accredited investors, and they come to us for, targeted 2.5 to 3 equity multiples on their capital over 3 to 5 year run. So that's the trajectory. And it took, I would say 5-6 years from multifamily investing up to where we are today.
So the transition from fixing flipping, did that predominantly happen in the COVID era when the hard money fund got shut down? Or were you still doing multifamily before then?
No, I was lending in that COVID period or leading up to the COVID period. I like the idea.
No ground up multifamily, just lending.
Yeah, just lending. And then I was put out of business in lending because of the COVID crisis and the line of credit. And the true epiphany for me is I want to control the capital, right? Mm-hmm. If I control the capital, then I can make the rules. Right. And, when you start looking at PPMs and the creativity and waterfall structures, et cetera, you can do a fantastic job for your investors, but you can also do very well yourself as a company or as an individual. So you're creating your own economic environment with less, stresses or pieces outside of your control. And so it was from the single families into smaller multifamilies, owning smaller multifamily portfolios, larger portfolios, lending along the way. Lending grew. And when the lending grew to what it was and then was shut down, that's what caused the transition and the pivot into Freedom Venture, our investment company as it stands today, with all the different projects that we have going on.
I'm curious, what were you borrowing the money at that $50 million Wall Street fund? And then what were you relending it out? Like what kind of spread?
Yeah. There was maybe 200 bips spread. So,
2 points.
Not huge. Yeah. Not huge. But, you charge a couple of points on the front, disposition scenario on the back. Yeah. What was profitable and strength for us was the fact of we worked with good borrowers. You know what I'm saying? So, and again, in Boston, the single family home median price is around anywhere between $550 and $650. So we're not writing $150,000 loans, 50,000 construction, 300,000 exit. We're not doing those. It's a bigger pot to play with. So if you can volumize that business, that's a strong business. You're making money on the spread. You're making your points, keeping the guys busy. as the owners of the company, we were taking maybe 75 bips. Our guys were working at 125 bips. So, it made sense. It was a good
Yeah.
deal. It was a good
Very,
model.
yeah, very profitable when you got 50 million bucks out there.
Yeah,
So
yeah.
one thing I'm curious of is $350 million of equity under management, multiple billions of dollars in your
Mm,
portfolio, very, very
mhm,
large portfolio.
mm,
What was it like? How did you start working with those institutional investors who could
yeah.
write those 5, 10, $20 million checks? And what did there's a huge change in thinking
Mhm,
that has to happen. I'm struggling with this right now.
yeah,
For you to go from going after deals that are, 4 or 5 million bucks, where you go raise 1 million, 2 million, and go buy a 50 unit or something like that,
yeah, yeah.
versus, hey, we're gonna go and we're gonna build 300 unit apartment complex. I mean, there's a huge adjustment in your thinking and confidence that has to happen. What did that look like for you? How were you able to do that?
Yeah, it's the quality of your team. So there's a misnomer that family office money is easy money. It's not. It's the hardest money. They got so much money. Why wouldn't they do this deal,
They're
right?
very, very, very particular about who they invest
Very
with.
particular. So to be successful in that arena, my secret weapon is my third partner, a young guy by the name of Eric Wilson. Eric Wilson has been with me for about 7 years. He's probably the smartest human being I know. Okay. And what Eric brings is a modeling ability and a data driven presentation that cannot be pulled apart, right? Um, so when we go into a presentation with a family office, first of all, we've done all the groundwork prior to that presentation to know exactly what it is that they want. Are they a self-storage, investment company? Are they multifamily? Are they ground up construction? What is their bread and butter? And a lot of the introductory conversations, you'll say, well, what's your sweet spot? What do you like, Mr. Jones? Right? And Mr. Jones will say, anything that pays me, XYZ return. And a lot of people will then take that at face value. And if you cannot build a strong rapport with the decision makers in that family office, I always look at it this way: they have a problem. Their problem is deal flow. I have a problem. One would say cash, right? Cash to do the deal, to fill that LP gap, maybe a co-GP position, whatever it is that it looks like. So if I am so tight on my pro forma, so tight on my numbers, and I can converse with them at whatever level they are, right? Some family offices are just Jimmy Joe, the construction worker. Hey, as long as we feel good about each other, it's going to work, right? And they truly are, and they still write checks. But then the real sophisticated capital, before you get to the higher institutional level, that sophisticated capital has absolute pinpoint data that they want to hit, be it job growth, rent growth, flattening in a market. They've got so many boxes that they choose to tick before they feel comfortable enough. And then at the end of the day, it's track record. It's track record. So when I can tell the story of, the principals having, combined maybe 50 plus years of experience, well, what does that tell a family office investor? It tells them these guys have been through market cycles. These guys aren't, one and done. They've suffered the arrows, if you will, that are consistently thrown in this business, and they're still here. They're still standing up. Is he a mensch? Is he a good guy? You know what I mean? Are you able to stay true? Because in Florida, we face everything, man, from, contractors who are straight up criminals to hurricanes to, we face it all. But again, that goes back to my point of what is a real emergency, right? If that family office can look at you and know that all your ducks are lined up, your numbers are tight. I mean, absolutely on point, and you've got the fortitude to push through no matter what, it becomes, and again, there's no guarantees. We still go through whatever 100 no's to get one yes. Don't take that personally, just keep going. But if you can tick all of those boxes with quality of underwriting and tenacity of the crew, does it flow downhill? Can I manage a contractor to make sure that he or she does what needs to get done in the time it needs to get done? And if you can keep pushing through those things, it becomes easier to get them to, the word you want to hear is programmatic. Every family office wants to be a programmatic lender. They want to be programmatic with a builder, with a repositioner, whatever your asset class is. And that just means they want to be the first phone call, right? They want to do multiple deals with you as you do with them, because if you're able to do that, you can now scale it up. So
what does the structure look like with these large check writers? I know a lot of the times, because of the nature of the family office, a lot of times the sponsor or the operator who's bringing it, asking for the money, I've heard they have to give up control of the deal, essentially, because of the amount of capital
yeah,
that's
that's a
involved
great
or the
question.
decision making.
We won't do that. We won't do that. If you want to build it, you build it. If you want to reposition it, you reposition it. I think a lot of the times, giving up control of the deal, when you hear that, it's almost a test. It's almost them testing you out, right? Because if you give up the deal at the first ask, what are you going to do when stuff goes sideways? Because it will. We won't give up control of the deal. We will have massive amounts of transparency. They may have a clause in there that says, we won't right of first refusal. If we can sell this asset at a 3.5 equity multiple for us, then we want to be able to, to do that, which is great. If it's a high equity multiple, I mean, everybody's going to win. Usually the larger check writer will come in with a different class of shares. Their return profile might be different if we've got a blend of investors, but everything's negotiable, Brandon. There isn't there is never, as I'm sure you can appreciate, there's never a one size fits all. But I would never, well, never say never, right? If your ass is on the line and you got to give up control, you might give up control, but that's not something that we look to do. And we find, again, great transparency and inclusion negates their need for control, even though it's their capital at play.
Now, it makes a lot of sense. What does that deal structure look like? Like, what does the waterfall, what does the equity split look like? What do the different shares look like for the family office versus, because I know there's usually a blend, right? You're raising money from friends and family or accredited investors that have,
Yeah,
one side of shares. That's usually your equity that you're bringing to the table, or your own personal capital that's got a
yeah.
certain class. And then the family office has another class of shares. The general partners has another class of shares. What's been a successful structure for you guys?
Yeah, we tend to bring, family offices like to see a higher participation in the equity by the GP. So we will typically look at anywhere between 5 and 10% of the equity need, be our contribution. If they're bringing the full 90% after that, then it can be a really aggressive split. You know what I mean? Is it a 50-50 deal? Is it a 70-30 deal? Again, every deal is negotiated to make sense. Everybody's got their wish list. It's usually fundamentally based on greed, right? But at the end of the day, pref equity, 7 to 7.5, 8%. We meet the first hurdle. Once we get to that first hurdle, it might be a 75-25. If we put in second and third hurdles, we might go 70-30, 60-40, and the lower portion obviously being on the GP side. But getting to cash flow is always key. Are they bringing any capital reserves in the sense of being able to underwrite any construction loans? If they start signing on the line, that's a true partnership as well. So that can increase their participation in in the delta and the flow on the deal. So, again, it's all fluid, man, but there's an average which isn't out of the box for anything special. I would always open up the conversation of, what's your ideal return profile look like, Mr. Jones? And let him shoot or her shoot, for the stars. And then
Yeah.
you laugh. You don't mean that, right? If I could, would you? And those are our sales techniques. If I could get you at an 8% pref and a 70-30 waterfall structure within X amount of time,
I
is that a
see.
deal that you would start to anticipate doing? So that's the structure and the way we work with them.
You're filling them out a little bit. For
Yeah, you
those
got to.
that don't know, how did you go about finding these large check writers, institutions, and family offices?
Yeah, that's a great question too. So, when you move into private equity, you really do spend a lot of time on the phones, right? Cold call outreach. We used to do a deal of the month podcast, or a show that we did that showed deals that we'd underwritten in the market. Didn't mean that we got them all. We underwrote them to make sense. So there was always chum in the water, and then it would take off between capital brokers, commercial real estate investors, smaller construction companies in the market that we were looking at. Somebody knows somebody knows somebody. I had also leveraged a lot of the TV show stuff. Hi,
Yeah.
this is Dave from Flipping Boston. You'd send them a little link. If they were a fan of the show, that gave me a leg up. But it's word of mouth for us. It wasn't so much in like direct mail marketing, but affiliate marketing along the lines of, if a broker had a list, what we're doing right now could potentially bring you and I, investors at whatever level, we don't know. So it's work. I haven't found the short run. There's a lot of crap out there on the internet. I'll show you how to raise $50 million in 5 minutes. BS. Come to my 3-day class and give me 50 grand for my inner circle. Do your due diligence if you're trying to learn how to raise money. But for us, it was tenacity, stick-to-itiveness, honesty, integrity. We've done well here. We haven't done well over there. What do you think? Is there I've had guys who say no and then come back 2.5, 3 years later and say yes.
Yeah.
Family offices. I did a couple of tours in Chicago that was set up by some brokers that we knew. So it's legwork. You need capital to support yourself as you're going through these phases.
Yeah. No one's going to do the work for you, right?
No,
There's
no,
no
man.
getting around. There's no
No,
shortcuts on
no,
anything.
no.
With all the success that you've had, Dave, what's next for you?
So that's a great question. I'd like to get better at systematizing and automating some of the processes. Ideally for me, if I could have maybe 10 meetings a week in the best steakhouses in the best parts of the country and walk away with a 25 to $50 million check writer each time, that would be my happy place, right? That would be my happy place. Now I could pray for that, maybe God will say maybe not, but what's next for me is leaning into faith, leaning into building the right team, getting some solid growth structure behind us. I'm never going to be BlackRock, but there's somewhere in between BlackRock and where we are now, and it's just a case of mapping out those 3 to 5 year plans.
Man, this has been an absolute pleasure. I know we didn't even get to go into your book, Wealth Without Wall Street. For those that want to learn more about you, learn more about your book, look at potentially investing with you, where can they go?
Yeah, if you go to Legacy Alliance on YouTube is our education platform. We just kind of started it. I've been doing a ton of recording with our marketing partners. Inside of there is a link that you could find to Wealth Without Wall Street. And we just put out an informational book around multifamily investing. It's a little flowery at times. I kind of got a kick out of putting it together with the guys. I'm just finishing up the audio recordings over the next couple of weeks. So Legacy Alliance, YouTube, that is our education arm. And then if you're already an investor and you understand the business model or you want to learn more about it, you can connect with me at freedomventure.com. Freedomventure.com. Freedom Venture is our investment company, management company. Or you could call 781-922-4418. I'm old school, baby. Somebody will answer the phone. Just say,
There
I
you
heard you
go.
on Brandon Cobb show.
Now it's kind of
So,
funny. You don't hear too many phone numbers these days.
yeah,
It's all emails and
yeah,
website stuff. Isn't that funny? And
yeah,
that's
dude.
always the
Yeah,
fastest way to get in
yeah,
touch.
yeah,
Uh,
yeah, for sure.
Well, Dave, this has been an absolute pleasure. Thank you for coming on the show today and sharing your wisdom.
Appreciate you, man. Thank you. God bless and good luck into 25.
Yeah, and hey, if you're listening to this, show Dave some love, show me some love, subscribe to the channel like this, and share it with your friends and family. We will see you guys next time.